Good morning and welcome to this latest Capital Economics drop-in, dissecting the results of yesterday's UK general election. And hello to listeners of the Weekly Briefing podcast. My name's Neil Shearing, I'm the Group Chief Economist. I'm delighted to be joined today by Paul Dales, our Chief UK Economist, Ruth Gregory, our Deputy Chief UK Economist, and Ashley Webb, our UK Economist, to break down what we learned last night and what the implications for the economy and the markets are. For those of you that may not have seen already, the result was, as anticipated, a Labour landslide. Majority at the moment, something like 170. They've got about 411 seats out of the 650 in Parliament. So yeah, majority about 170. That's a bit smaller than Tony Blair had in 1997, but kind of similar order of magnitude. And really the story of the night was not necessarily a surge in support for Labour, but a surge in support for Reform, the right-wing Reform Party, which split the Conservative vote and really delivered that big majority in terms of seats for Labour. So Labour's vote share has only gone up by a couple of percentage points, but it's been massively more efficient as a result of in terms of delivering seats as a result of the split in the right vote. We're going to talk today, though, about the implications for the economy and for financial markets. By the way, markets have not really moved on the result. It was pretty well anticipated. Telegraph, sterling's up a bit this morning, but no major moves. Paul, let me turn to you first. Walk us through the kind of headlines in terms of what this means for the economy. What does the Labour government mean for the economy? And as important, what are the things we should be watching for in key milestones over the next few weeks and months?
Yes, I mean, it's a big political change, but actually for the economy, the change isn't as big, anywhere near as big, really, simply because Labour is taking over and the same economic constraints and fiscal constraints are there. So we're not changing our economic growth forecasts, and we're not changing our inflation or interest rate forecasts in response to the Labour victory. But there probably is a little bit of upside to those forecasts, actually, and that's because the composition of Labour's fiscal policy is probably going to be a little bit more growth friendly over the next few years. Not a lot, but maybe slightly. And further ahead, actually, Labour does have what we think are encouraging plans to boost home building and a more favourable outlook for things like green investment and public investment, which could help improve the UK's medium-term growth prospects. Now, that does mean at some point the UK may be able to sustain greater demand because there's greater supply. But in the near term, if that happens over a period of 1 or 2 years, you might get a little bit of demand bumping up against supply before that increase in supply really comes through. So it's more about the risks to the forecast, really. And we'll learn more really when we get the next fiscal event, which could be sometime in September.
Okay, so a bit of upside risk to our GDP forecast, bit of upside risk to our inflation forecasts, and we'll know more at the fiscal event, which we're assuming is going to be the first fiscal event, which we're assuming is going to be sometime in the autumn, possibly September, October time. First question that's come in is about the size of the majority that I mentioned earlier. And given the scale of the majority, what are the implications in terms of the speed in which policies might be rolled out? What's your sense? No need to rush if you're a Labour government. You've got a big majority. It's not like they're going to be beholden to a few kind of MPs on the fringe of the party. They can govern from the centre. They can take their time, do you think?
I think so, yes. So there will be a lot of noise and there'll probably be a lot of discussion about what's going to happen in the first 100 days. And it seems that Labour is going to concentrate on housing reform and try and change the planning laws so that it can grow residential investment. And that's actually, the kind of costless kind of policies in terms of when it comes to monetary figures anyway. But when it comes to the fiscal situation, I think you're right. They can take their time a little bit here. And it might be the case that time is on their side because we know that inflation has just fallen to 2%. The Bank of England is on the cusp of cutting interest rates. So Labour might be inheriting an economy that's giving it a bit of a tailwind, which means that the fiscal constraints might not be quite so tight at the upcoming fiscal events, whether that's the next one, which might be September, October, or one next year. So if it sits tight, it might get a bit of a helping hand from the economy, and it means that perhaps the decisions on public spending aren't quite so tricky when those decisions need to be made. But it does feel to us that there's not going to be a huge deviation from the Labour manifesto, and certainly not soon.
Yes, you mentioned a few points there about housing. I want to come back to that because we've had questions submitted in advance over our advanced platform on housing. We'll come back to those, but you also mentioned implications for public spending. We've had some questions on that too. So Ruth, I'm going to turn to you on what all this means for fiscal policy. Specifically when it comes to public spending, what are we assuming about Labour's spending plans? We know that the current government, the previous government, previous Conservative government, had inked in quite substantial, in real terms, cuts to government spending, particularly over the back end of the forecast that you thought was perhaps looked a bit unrealistic. What do we know about Labour spending?
Yeah, I think we know from Labour's manifesto that it plans to top up overall public spending on public services, I think by around 5 billion by 2028-29. So that would mean that overall public spending in day-to-day terms is set to grow by 1.2% a year from 2025 rather than 1.1%, which was the previous government's plans. Having said that, a lot of that money is earmarked for things like the NHS and for schools. So Labour's plans still mean that spending would need to be perhaps around 6 to 16 billion higher by 2028 than its manifesto suggests, if it wants to prevent those big real-term cuts on protected departments, so areas outside the NHS and outside education, from falling in real terms, as you mentioned. I think, as Paul was saying earlier, our hunch is that Labour won't really rush to address this. It may stick to its manifesto plans for a small top-up in public spending certainly over the next 6 to 12 months, and perhaps the hope would be that by that time the economy's helped it out a little bit, or alternatively it's built up a bit of fiscal credibility and is able to increase spending without upsetting the markets.
Yes, the key point in all of this, isn't it, is whether or not it's a kind of 1% increase in real terms in nominal terms that we had under the previous government's plans of 1.2% a year increase in government spending. These are pretty small numbers, aren't they? They're not dramatic, dramatic increases in spending or deviations from previous plans. So it's still a pretty tight fiscal programme. A related question that we've had surrounds whether or not there's a kind of so-called black hole in the public finances. We know that there's not much headroom against the current set of fiscal rules. We know that Rachel Reeves has committed to retaining those sets, the current set of fiscal rules. What's your sense in terms of whether there's a kind of hole to fill on the fiscal side, and if so, how they might go about filling it?
Yeah, I think if you look at the manifesto plans that Labour plans to raise spending a bit more than the previous government planned, and that's funded by higher taxes. So borrowing is not actually that much higher. So on paper, there isn't really a sort of fiscal black hole that needs to be filled. I think in reality, it will come down to whether the policies are realistic. And we've talked about some of the big unanswered questions, haven't we, on the implausibly low projected path for public spending. And at some point, Labour will need to address that. There are other questions around whether the new government still wants to cut public investment as a share of GDP. I think its Green Investment Pledge is still consistent with a reduction in public investment from 2.4% of GDP to 1.8% by 2028. And I think if Labour decides that spending needs to be higher, then taxes may need to be raised by more than in its manifesto. I guess in all of this, the OBR may give the new government a bit of a helping hand at the next fiscal event in September. We've run our estimates of the fiscal headroom. We think the OBR may give the government headroom of around 16 billion, and that would be up from around 9 billion at the time of the March budget. So Labour may have a little bit more room to manoeuvre in a sort of September-October budget, but it wouldn't allow it to do everything it wants all at once. And particularly in terms of these questions that are unanswered, it would allow it to reverse some of the scheduled spending restraint, or perhaps to reverse the ongoing freeze on personal tax thresholds, but not both of these things at the same time.
Thanks, Ruth. Yeah, there's an awful lot of focus on the new government being constrained fiscally, but for what it's worth, my sense is this misses the point. The key point is you've got to get growth going in the economy, and doesn't feel to me like it's an economy that's particularly demand constrained. We're pretty much at full employment, so it's not obvious to me, at least, that fiscal constraints are major bind on the government. It's much more about how do you get growth going on the supply side. And in that vein, Paul, we've had a question about how can the government get productivity growth? How can it reinvigorate productivity growth? I know you're undertaking quite a big piece of work looking at this at the moment. Give us the kind of key takeaways.
Well, it is a big question, but the diagnosis is right. The problem is slow productivity growth, which partly is due to slow investment growth. That's certainly weaker in the UK than it's been in the G7 over the last couple of decades. There's been a lot of analysis and work done on this in recent years. I think a lot of it misses two key points, though. The first is that some of the reasons behind low investment and slow productivity growth are cyclical rather than structural. So that means they're not going to be around forever. Those drags will probably fade. And within that, actually, we need to acknowledge there might be some positive structural forces coming through. In particular, we're quite optimistic that artificial intelligence will boost productivity in most major economies, with the UK actually benefiting by more than a lot of other economies. The second point is that the second point that's often missed is there's simply no one single silver bullet or thing that will move the dial on this. Instead, you need a package of long-term measures that address the macro issues, but also take into account the micro issues. So what we really need to do is need to boost investment and productivity. And I think the way to do that is to start with something like home building, which has been unusually low and far too low. Change the planning rules there to generate more home building. That will boost residential investment. The new government needs to create an environment to boost business investment as well. And I think one thing they could do there is try and change the outlook of the corporate sector from just thinking about short-term returns to more longer-term plans and longer-term investment projects. And the other element of this that is often forgotten is that if you want investment to be higher, then you need domestic savings to be higher too in order to fund it. So policies that would raise the savings of households or businesses would be quite a good thing. It might be, for example, that employers and employees are forced to pay more into a pension every month or every year. That could be one thing that could be helpful. So, but then, just even doing those things on their own, they're all going to help, but then it needs to be thought through. So if you're going to move the dial on some things, you need to think about how it interlinks with other plays. So, for example, if you wanted to boost the supply of labour, which you should try and do as well, then you probably need an element of housing reform, tax reform, childcare reform as well. So it's quite a complex package, but our sense is that Labour's focus on the housing market is certainly promising. And also it seems much more focused on maybe using green investment and green technology to boost business investment as well.
Yeah, I think that point about that this needs to be a package of reforms because there's interlinkages and interdependencies is a really key point. There's not just one lever you can pull because often you need to do several things in order to achieve an outcome. The other absolutely critical point, and it's a drum that I will not stop banging, is that you're right. If you want to get the investment rates to share GDP up, which is kind of motherhood and apple pie and every politician wants, you need to get the savings rate up as a share of GDP. Otherwise, all you're going to do is push up the current account deficit, UK's current account deficit, even higher. And it's already pretty large as it is. So, yeah, we need to hear much more about what the government might do to raise the savings rate. I think you're right. Pensions reform is an obvious place to start. Not heard anything on that front yet, though. We've spoken a lot about housing. Ash, I'm going to come to you about housing. We had a question before the session started to begin through the advanced platform about what the new government might mean for the housing market, in particular, house building and house prices. We've also had a related question in the session today about what it means for infrastructure spending in the construction industry. Of course, the two things are related. So walk us through the kind of key points here. I mean, every government promises more houses. No government actually does it. Every government in waiting promises planning reform. No government actually does it. Is there any reasons to be more optimistic this time around?
Yeah, as we've said, Labour has made housing a key plank of its offering. And there are a few reasons to be a bit more positive that that Labour may be able to achieve it, unlike the Conservatives were. And that's basically because of the party's more positive attitude towards new towns and social housing, as well as its pledge to reform compulsory purchase laws as well, which will mean it can acquire land more cheaply, and then either use those savings to boost house building, public house building, or to fund more attractive contracts for private house builders that insists on, higher levels of housing delivery. And with that latter one, that could actually be delivered without Labour risking breaching the fiscal rules. So that's really why we're more optimistic that Labour could do it. And if that is successful, increasing house building could actually have a significant impact on residential investment and construction by means of doing so. Currently, 225,000 houses are being built a year. Labour's target is 300,000. And if it was able to achieve that 75,000 differential, that could raise residential investment from around 4.5% to 5% of GDP now to about 6.5% of GDP, which would add around 1.5% to 2% to overall GDP. So the boost to residential investment and growth could be significant. What I would say is that these reforms will likely take time, and what matters most for house prices in the near term is what's going to happen next to monetary, to bank rate and changes in monetary policy. And if we're right in thinking that the Bank of England will cut interest rates faster and further than the market expects and most other analysts expect, our view is that rates will be cut from 5.25% to 3% by the end of next year. Then a decline in mortgage rates should lead to a pickup in house prices in 2025, after more of a tepid increase of this year. But as I said, Labour's housing reform is likely to take time, and so that's why we think house prices will rise in the near term. But in the medium term, if Labour's reforms are successful, then house prices may rise a bit slower than otherwise thereafter.
It's interesting. There's a whole load of levers they can pull that don't incur any fiscal costs. Things like reforming how compulsory purchase orders work. Land banks is very. We're not talking about land banks, but that's another area they could think about. I suspect. Ruth, I've had a question specifically on projections for debt interest costs and the amount of the UK budget or the government's budget that's been subsumed by debt interest costs, and whether that's a significant consideration and a constraint on the government. What's your take?
Yeah, if you look at the share of public sector receipts, the share of taxes that debt interest takes up, that's gone up from just shy of 5% before the pandemic to around 9.5% in the last fiscal year. And I think the OBR's forecast for debt interest payments to remain pretty elevated, still at around 8.3% by the end of in 5 years' time. Our forecast is for debt interest payments to fall a little bit more quickly. That's based on our view that interest rates fall faster and further to 3% next year rather than to 4% as investors expect. But I think the key point here is that debt interest payments are taking up a larger share to the tune of around 1% of GDP. And that does mean that fiscal policy needs to be tighter over the next decade than over the past decade. So if you look at the fiscal plans, we don't think Labour will significantly deviate from the previous plans in gradually tightening fiscal policy over the next 5 years.
Great, thanks very much, Ruth. I've had a few questions about individual tax measures, whether we might get tax breaks for things like infrastructure investment. I think it's possible. The devil will be in the detail. Let me say there's not much room for fiscal maneuver or big tax breaks, but I guess it's possible we could get smaller tax breaks. But my sense is that, I don't know if you agree with this, Paul, my sense is that there's a lot that could be done on the supply side of the economy that would be fiscally neutral. It's not necessarily going to incur large amounts of either need for large tax cuts or spending increases, given that a lot of it's about kind of trying to stimulate private investment through regulatory reform and so on.
I think that's exactly right. And Labour hasn't provided huge amounts of detail here, but it has said that it's going to set up a couple of enterprises that will help with infrastructure spending, GB Energy, for example. And one thing I've heard from numerous clients is that they know businesses that want to set up factories or what have you, but actually they've been told they can't get electricity to those factories until the 2030s. So Labour have said that they're going to try and sort that out and prioritise areas that they think are more important for the economy, which might be anything related to AI or energy or, electric vehicles, for example. So I think I get the sense there's a bit more willingness to be a bit more helpful there, although we haven't seen any details yet, so I don't go too far on that. The other thing that we've sort of alluded to is that at some point, if Labour manages to not rock the boat, prove its fiscal discipline over the next year or so, then that might buy a bit of goodwill, and it might be able to be a bit more radical further down the line by perhaps tweaking the fiscal rules to allow a greater carve out for public investment, which might help stimulate infrastructure spending either directly by the government spending or indirectly by spillovers to the private sector. So it might be that there won't be huge amounts of developments there in the next year or so, but further down the line, that's maybe something that Labour will turn its attention to.
We're rubbing up against time, so we'll keep our answers brief, but there's two areas we've not touched on and we've had questions about. First is labour market policies. The second is implications for inflation and Bank of England and UK interest rates. Labour market, I guess the key question is, do we get further increase in the minimum wage, expansion of workers' rights? Does that, against the backdrop of the tight labour market, does that stimulate wage inflation? Don't know whether you kind of agree with that, Paul, Ruth, views, but, let's unpack what it might mean for the labour market.
I can have a go at that. I mean, the thing here is you're right. We've got a relatively tight labour market. We've got wage growth that is around the 5.5-6% mark instead of the 3 to 3.5% mark that would be consistent with the 2% target. So any kind of measures that really turn a dial there and make the labour market less flexible is not going to be great from an economic point of view. Perhaps the biggest one here is minimum wage. It might be the case that Labour wants to be more generous when it comes to the minimum wage and widen it out. So that could mean there's a slightly bigger increase in the minimum wage, perhaps in April next year than would otherwise have been the case, which gives wage growth a bit more support. But overall, when it comes to the labour market, I think where there might be some changes here and there, I think the real issue is what's going to happen to demand in the economy and supply in the economy. And our sense here is that actually over the next year or so that there will be some improvements in the labour market that allow labour supply to grow a bit faster than demand. So that should bear down on wage growth. And at the same time, the previous declines in inflation to the 2% target should filter through into businesses and employees' inflation expectations, which should reduce wage growth as well. So in essence, while we said at the start there might be a little bit more upside to our inflation and interest rate forecasts over, as a result of the Labour victory, those upsides aren't big enough to actually change our forecasts. We still think that inflation will be a bit lower than most people expect, maybe perhaps even below the 2% target for the next 6 to 12 months. And as a result, the Bank of England will cut interest rates from 5.25%, perhaps at the next meeting in August, and all the way to about 3% next year. So that's our base case at the moment. It might be that maybe interest rates don't fall quite as far and inflation's not quite as low, but in the grand scheme of things, that's the broad picture we're expecting.
Okay, so bit of upside risk to our GDP forecast, bit of upside risk to our inflation forecast, perhaps a bit of upside risk to our interest rate forecast, particularly if there's efforts to push through further large increases in things like the minimum wage. But overall, the broad trajectory is still one of gradual economic recovery. I've forecast a bit above consensus already on the GDP growth, inflation coming down, and the Bank of England supporting that recovery by being able to take their foot off the monetary pedal, so to speak, and get nominal interest rates down. So thanks very much for your time, everyone on the panel. Thanks very much for your questions, everyone in the audience, and for contributing what I hope was an interesting and stimulating session. Thanks very much to everyone listening on our podcast. If you're not listening to our podcast, sign up in all the usual places, Apple, Spotify, and so on and so forth, and give us a favourable review. For now, though, thank you very much for joining us, and we'll speak to you again soon. Goodbye.
Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.